So we had kind of an equity bubble, and then when that popped, we purposely kind of inflated a housing bubble, and then when that popped, we inflated basically a sovereign debt bubble. And the problem there is when that pops, that's when the currency gets devalued. Basically, that's the end game. Now, if you were to then apply that internationally, that's where you can affect certain things like global reserve asset status and structures of the monetary system. Because if basically if a country's going through a currency devaluation, but it's at the heart of a global monetary system, you can have a shift there.
Welcome to the Gold Republic Podcast. My name is Bart Brands.
And I'm Alexei Jordanov. In our weekly podcast, we invite guests from all over the world to get valuable insights
into the emergence of a new monetary system through the lens of precious metals, cryptocurrencies, and other financial instruments.
Welcome to the Gold Republic Podcast. Today we have the great honor of welcoming Lyn Alden. Lyn Alden is the CEO and founder of Lyn Alden Investment Strategy, who's a prolific macro investor providing market research for hundreds of thousands of individual investors and financial professionals every month through her invaluable newsletter and regular articles focusing on fundamental investing with a global macro overlay, including currency differentials, shifts in monetary policy, and equity valuations. Lyn, I was actually very curious to know, what was your childhood dream?
Probably engineer or astronaut, that sort of thing.
Oh, engineer or astronaut. And why one of those?
I don't know. I just, I kind of just was interested in technology in addition to finance. And so, I ended up going that more engineering route. Like my bachelor's degree is in engineering. So I kind of, I pursued electrical engineering and then kind of applied it to aviation. So I got kind of close to the astronaut idea, and then shifted over increasingly towards finance.
Yeah, you could say, and forgive the play on words, you shifted spaces, not just out there, extraterrestrial, but also in terms of domains, which makes it even more fascinating, especially in current times, right, where there's an overcross of so many disciplines. So
yeah.
In that sense, what is, let's say, your biggest life KPI? And this sounds like now very financial or engineering, but in that sense, what is your purpose, your life purpose, what you're trying to achieve?
I think mainly just I found that I enjoy educating, and so I enjoy sharing things I learn, which is why I like doing research rather than just asset management. Is rather than just applying, I like applying it as well, but I also like sharing it with others, and so whether that's writing or speaking, and so I think I just find that trying to understand something and then in sharing it with people, and I generally find that I learn the most when I'm trying to teach someone else, because you have to really make sure you get it right before you kind of lay out the whole thing. And so if there's little areas you're not getting, that basically is a really strong incentive to go in and kind of really figure out those details. Whereas if you're just trying to learn something, if there's something you don't get, you can be like, that part's probably not important, and you kind of skip over it. Whereas if you're really trying to make sense of it and basically enough to share it with someone else, it really kind of forces you to figure out all the little details.
What were your biggest revelation in that process?
Just how the funny thing is, I guess the revelation was how interesting writing can be, because when I was kind of going through schooling, I was never a good writer. And any English major reading my stuff now would still not say it's a good writing, but basically I was very focused on the math and the science and not really into the writing. Whereas now I can write very, very long articles very quickly and get positive feedback on them, even though maybe grammar is not my strongest suit, but it's still just through sheer practice it became more enjoyable and more efficient.
And do you notice any commonalities?
Well, I think not between writing and the other stuff, but more like the engineering and the finance certainly have commonalities because they're very quantitative focused, and it's really kind of just figuring out how things work. And one of the differences between engineering and science is that sciences are trying to figure out how things work, whereas engineers are trying to how to then take science and basically apply it. It's like applied science, and finance is kind of the same way. There's people that are just trying to figure out how things work, and they don't really get kind of tested on a regular basis about whether they're right or wrong. That's why we can say like a lot of economists can be just wrong for decades about things because there's not kind of that real world feedback that happens pretty quickly. Whereas if you were trying to run assets and make investment decisions, you get that feedback pretty quickly, just like an engineer. So I generally find that asset management and engineering have a lot of similarities, whereas writing is kind of a whole separate field, at
That's
least for
very
me.
that's very revealing because there's also this kind of difference of what you just mentioned with economists. Economists don't have a lab, chemists do. They do direct experiments, they see the direct result. But for economists, what would their lab be?
Exactly, and well, that's one of the things. So when it comes to really complex fields, I think nutrition and economists are kind of similar in that regard because it's really hard to test something because like if you want to test what is an optimal like nutrition for a human, like you got to run it for like decades, and you can't control someone's diet for decades, and so it's really hard to do good studies in nutrition. And you can do it on mice, but that doesn't tell you a ton. You can do surveys, but surveys are poor, and so there's all sorts of errors. And plus, the human body is just one of the most complex things out there. I mean, we barely know how a single cell works, let alone if you go down to the molecular level, the crazy things happening in a cellular level, let alone the whole body. And the global macro economy is the same thing, where it's just hugely complex, decentralized, mess of things going on, and experiments that we can run on it are rather far and few between. And the sample size is pretty small because you have to go back really long periods of time to get a full data set. But then if you go back too far, technology and finance is all different. And so basically you're kind of working with unreliable data in a similar way that a nutritionist would. So I actually consider those fields, pretty similar.
That's just fascinating. So, if you would be in that sense, Bob Ross, how would you paint the picture of the current monetary system's environment?
Well, he always paints things that look beautiful. Like so, it's hard. I don't know if a Bob Ross picture would cover it. It'd be more like a Picasso painting.
In the
It'd be
simplicity, there's little sprinkles of quantitative easing over there, and then
yeah,
some
it'd be like a forest filled with money. Like all the leaves are money, and you just kind of paper over it with money. It's simple. It's happy trees.
happy trees and happy happy accidents.
Yeah.
So, what are the major happy accidents in today's monetary system?
I don't know about happy accident. It's more like just basically trying to push on a string, essentially. I mean, that's what they're trying to do is that, it's never really about solving the problem. It's about elongating the problem or pushing down the brunt of the consequences of the problem rather than trying to get to the root of the problem. And there's a couple different fields where there's not just one root of the problem. There's like a handful of different kind of, parts of the problem, but it's always just about pruning it and guiding it rather than really kind of figuring out some of the hard parts that are not working right.
Hmm. So it's said that economists usually use their labs as kind of the history books to look also at history. You just mentioned that you have to look back at data, and even though sometimes data is reliable, how would you say we got here until the present moment from in terms of framework cycles, or let's say the best angle that you usually discovered enables us to explain us the current situation?
I use two parallel frameworks for that because I think they're both somewhat independent and they both led us to different parts of why we're here. And so one of them is the concept of the long-term debt cycle, which is popularized by Ray Dalio and over the past decade. And it's the idea that if you have multiple short-term business cycles, 5 to 10 year business cycles, when you eventually kind of you build up leverage throughout the cycle. And then when you eventually run into some sort of external catalyst or the central bank tightens or something triggers, an over-leveraged system to start to deleverage, you start to deleverage, and then but because it's painful for people, it's a recession. Policymakers step in and they kind of short circuit that deleveraging before it can complete, and so you end up the cycle with higher debt as a percentage of GDP than when the cycle began, even after the period of deleveraging, and you end up with lower interest rates than previously. So when you string multiple of those cycles together, you end up getting higher and higher debt as a percentage of GDP and lower interest rates until you hit zero bound, or in Europe's case, and mildly negative, and your debts become extremely high as a percentage of GDP, and compared to the money supply and compared to all other factors, and eventually that causes a major banking crisis. There's basically just nothing more you can squeeze out of that paradigm, and so that eventually shifts more towards asset purchases and a period of deleveraging. But then ultimately that cycle doesn't really end until there's a significant currency devaluation. And so that's what kind of characterizes the end of a long-term debt cycle, is that there's so much debt in the system that it can't be deleveraged nominally anymore, basically without imploding the whole system. And so they end up turning to a period of currency devaluation. And so that's the concept of the long-term debt cycle. And basically we're on kind of that, the by most accounts, the debt cycle kind of peaked back in that 2008, 2009 period. And we've been in that private sector debt bubble kind of stagnation, deleveraging. But now we're in kind of that second part of the public debt bubble, where basically now it's the currency itself that's more likely to get devalued here. And then the other big framework would be just the different structures of the global monetary system over time. So we had the pre-Bretton Woods system, then we had the Bretton Woods system, and now we have the petrodollar system. And each one of those cycles tends to have a really kind of they often also have a currency devaluation in the middle between the transitions. And so those kind of two directions are kind of how I kind of have a big context of where the global economy is.
Mm-hmm. And that is very telling in a way, because if you understood it right, it's you get from banks and institutions to now sovereign debt, which is basically state level. What would be the meta level of this? Because we also have an increasingly connected financial and monetary system where the debt is also shared and distributed all over the world. Is there maybe a next level above that we can think of?
Well, I mean, ultimately it comes up to currency. But I guess if you were to then, basically to kind of illustrate your point more. So we had kind of an equity bubble, and then when that popped, we purposely kind of inflated a housing bubble, and then when that popped, we inflated basically a sovereign debt bubble. And the problem there is when that pops, that's when the currency gets devalued. Basically, that's the end game. Now, if you were to then apply that internationally, that's where you can affect certain things like global reserve asset status and structures of the monetary system. Because if basically if a country's going through a currency devaluation, but it's at the heart of a global monetary system, you can have a shift there. And so I wouldn't necessarily say that's like a higher level, but it's kind of an overlay of multiple high levels. So every currency block that owns its own currency has the kind of the unilateral ability to devalue its currency, but that does have international implications, especially if it's a large market or if its currency is used internationally.
Can we then talk about the war of currencies?
Well, that's been a big trend for the past few decades, where we've had kind of currency wars happening, and this structure ever since the 70s kind of encourages it. It's kind of built around having most countries try to devalue their currency, especially compared to the dollar, so that they can have competitive exports to sell things to the very large American market. And then as say China opened up, again we've shifted more towards say Germany selling cars to China, China selling manufactured goods to the whole world, Latin America trying to sell agriculture to China. And so a lot of it is about, ironically, keeping your currency somewhat weak. And that's, for example, what Europe's been doing to some extent, where a lot of their economy relies on having a trade surplus. And so they basically been using aggressive monetary policy in part to try to make it so that the euro doesn't strengthen compared to the dollar, because that could damage the export market. So basically what we see is that, because the European Union is so reliant on exports, especially the northern part of it, that basically it basically encourages them to maintain really loose monetary policy, in part to keep their currency from strengthening compared to the dollar. And so in the United States, we've been using pretty heavy fiscal policy, whereas Europe, it's more about pretty loose monetary policy, because they have more restrictions against being able to do fiscal policy, because they've split their their currency around, whereas the ECB can still act rather unilaterally. So in lack of fiscal, they can do monetary policy to keep that going. And so basically this whole system that's in place since the 70s really encourages all these different countries to try to basically gradually devalue their currencies where possible. We've seen similar things out of China, and it really kind of comes down to what they're trying to do. So when China was trying to rapidly grow, they were trying to keep their currency really weak. Now that they're shifting more towards a middle income country, and they want to encourage some degree of private consumption, and they want to be able to buy commodities, they've been kind of now steadying that a little bit, where they're not kind of aggressively devaluing their currency anymore, but they're still managing it.
Amazing, Lyn. And we already hinted at it. You have theory and you have the application of theory into practice. And we've seen that with a lot of economists, that they are stuck in certain theories. You wrote an excellent piece about the Japanification and what the differences are between Japan and the United States. And they all hint towards what we could say is a paradigm shift. Where are we in that sense, and what are the indicators that we can discover to show where we are in that paradigm shift?
So I think going back to those two parallel frameworks that I applied, I think we're on kind of the later stage of the climax for the long-term debt cycle, and probably an earlier stage part of the climax for the global monetary system change. And so what I mean by that is, if you look at the way the long-term debt cycle ends, it kind of ends in two parts. One is you have a private debt bubble collapse. And so, for example, a lot of countries had that back in the late 1920s, especially the United States. And then, the next one was the 2008 crisis. And so by many metrics, those two events look very similar, based on all sorts of bank leverage ratios, based on private debt to GDP ratios, ratios of, say, bank loans compared to the monetary base in the United States. And then, the second part of that cycle, or kind of ending stage, is a public debt bubble. And so that's the more inflationary one. And so in many ways, I compare the 2020s to the 1940s, not necessarily including a world war, I hope, but in terms of having basically a very large fiscal-driven inflation while holding rates pretty low, basically inspired by an external catalyst, but combined with the fact that debt was already so high. And so that's kind of what we're seeing play out there. And I think we're in that last decade of that big cycle. And then in terms of the global monetary system, we're still somewhat earlier, but it's kind of a process playing out where the United States used to have most of, well, it still does in many cases, all global energy priced in dollars. Where if France or Japan buy oil from Saudi Arabia, they pay in dollars rather than any of their local currencies. And we've had that near complete lock on the global energy market since the 70s. But we increasingly see in the past 3 years or so that Russia, for example, has been interested in selling oil in euros, and they've been successful at it as far as most metrics can show. And we see China being increasingly interested in being able to buy commodities outside of the dollar-based system. And so, but this is a process that has taken a while. And so, I think we're kind of in the middle stages of that kind of playing out, where we see kind of the direction that it's heading in, but it's still unclear how long that's going to take. And there could be certain decision points that accelerate or decelerate. So, for example, one of the reasons Russia's accelerated is because of sanction pressure. And as United States and China have more animosity towards each other as kind of competing powers, there's more incentive for China to try to decouple. And then one of the other challenges is that even this current system, that in many ways benefits the United States, it actually is starting to undermine the United States, because it basically enforces that we have a structural trade deficit. And that worked for a couple of decades, but now it's really kind of coming back to bite us. And so it's one of those things where the current system really only benefits kind of a smaller percentage of, say, American society, whereas the lower half of American society that is more involved in blue collar type of trade or making things that used to be in many cases rather prestigious jobs, have now had their wages compressed because basically the United States globalized its manufacturing base quicker than, say, Europe or Japan did, because we've basically the way that the current structure works is that we kind of force ourselves to have these trade deficits.
And there was one thing that I wanted to follow up on, because both in the 1920s and the follow-up, of course, then we see the 1940s, but also in the '08 crisis, and now because perhaps the hegemonic powers of the United States might be threatened by, for example, decoupling of the dollar, could result into what? Well, of course, in the previous examples, they resulted into either war or intervention. Is this a natural outcome of maybe the end of the cycle where we're heading at, or would you say this is not always the case, or what do you see in that front?
It's not inevitable. It's human nature that it tends to happen that way, but it's not inevitable. And so, for example, one of the frameworks that I've put out is basically that the United States has empire-like characteristics where they're very focused on their influence abroad, based on, for example, the fact that virtually all global energy is priced in dollars, and the United States has the only real navy that can go around the entire world and kind of enforce shipping lanes and maintain that status. But that's also come at a big cost to the domestic economy vibrancy. We basically traded our trade deficit for global influence. And so if you are at the top of American society, like if you're running a corporation, if you're in the DC area, if you work in technology or healthcare, things like that, then you weren't really impacted by any of the downsides, but you got a lot of the upsides of that system. Whereas if you work in manufacturing and other types of trades, you got a lot of the brunt of that system. You got the downside of the system and only some of the upsides. And so basically the United States could choose to pull back a little bit on its international ambitions and have a stronger domestic economy and vibrancy, kind of, basically more people participating, or they can kind of, fight to maintain every inch of global influence they have. And I think it's one of those things where it depends how wise policymakers are and how kind of long-term thinking they are versus short-term thinking. So I don't view war as inevitable, but it's one of those things that it always breaks out when reason fails.
Coming on to bridging on Bart's question, we witness an interplay of different domains on a global scale, but not only on a macroeconomic, but I like to actually call it maybe meta-economics, where we basically include different domains like technology, geopolitics, mass psychology, finance, the monetary system, demographics that we didn't touch upon yet. All those domains are so interconnected nowadays that we can call it a certain form of convergence. What does it mean for the next decade to come? As you compared now this cycle to the similar cycle of fiscal dominance of the 1940s, but that we can add as an add-on or like this hybrid kind of very confusing times as well, also from an information technology perspective, to navigate in the next decades to come?
Yeah, it's a really good set of questions. And it's one of those things where it goes back to that quote of history doesn't repeat, but it does rhyme. And so, I've generally found that the 1940s are the closest comparison to the 2020s in terms of fiscal and monetary policy, as well as they had a change in the global monetary system then. And so that's the closest one, but it doesn't mean it's going to play out the same way because technology is different, demographics are different. And so in many cases, the United States looks more like the UK in that environment. Where they kind of were the leading power that was kind of having their position kind of stretched out and now kind of reaching its apex, whereas the United States was essentially the ascendant emerging market, the big manufacturing hub. We were running trade surpluses back then, whereas now we're the ones running trade deficits. We're the big consumer market, and so there are differences like that. I think one of the likely similarities is that the 2020s are likely to be a more inflationary, commodity-driven decade. Now, that's still subject to certain decision points. It depends on how much fiscal kind of spending still happens among different governments and kind of what evolves here. But basically, as it's playing out, it looks like a rather commodity-driven decade. But then where it goes from there can take a bunch of different turns because it partially depends on what happens with the European Union and more specifically the Eurozone. It happens, what's going to happen between, say, the United States and China, maybe involving areas like Taiwan that are kind of that tail risk that's always out there. And so basically, it's one of those things we navigate over time, and we try to say, okay, here's where it's similar to, say, the 1940s, but here's where it's different in terms of technology. So, for example, certain types of technology make, in some ways, war less likely because, kind of like how United States and Russia never did a war because it would have been so destructive that it basically limits how much kind of, war can even happen. And so in some ways that can prevent war. But on the other hand, if it were to happen, obviously it can be more catastrophic. Then you have things like technology makes things usually easier, but it also displaces workers. And so one of the comparisons I made is that the 2010s were a lot like the 1930s in the sense that we had an industrial depression, essentially, where if you look at the industrial base, it just kind of went sideways for more than a decade. But because the United States had back in the 1930s, the United States had the Dust Bowl, right? So our agriculture collapsed, which caused great poverty. Europe obviously was still reeling from World War One around that time, and so basically. With technology, things weren't as bad in the 2010s as they were in, say, the 1930s, and so basically all those things kind of play out in a similar way. Another thing that you can watch is shifts in pro-establishment politics versus populist politics. And so generally when you get these cycles between, say, how much wealth concentration there is, usually when you get more and more wealth concentration, you start to get a rise in populist politics of people who feel that the system's not benefiting them, that it's kind of structured against them. And so you get more and more of that. And that's generally what helps cause the next kind of pro-inflationary cycle, because as that kind of faction gains more control, that tends to be associated with fiscal type of policies that are more inflationary in nature. And so by monitoring the different political threads that are happening, by monitoring the geopolitical kind of rising power, falling power shifts, and then looking at the long-term debt cycle and the structure of the global monetary system, basically we have these various kind of long-term frameworks playing out. And it's challenging because those don't tell you what to buy this week compared to next week. But it's more about making, say, 5-year forecasts, which are still a measurable period of time. It's not like, say, an economist or a nutritionist trying to make a 40-year forecast. You're trying to make, a few years at a time and play things out as that moves along.
One of the forecasts, and I think that would be a forecast for the next 5 years, for example, and it is also what happened during the Dust Bowl. And in Europe, we had, after World War One, the hyperinflation in the Weimar Republic. Well, we're seeing inflation ticking up everywhere. You mentioned it, inflation and commodities. What would you say? And of course, that is also where a large part of the populace really hurts in inflation. What would you say would be a forecast for inflation the coming years? And could you also perhaps tell us what your specific definition of inflation would be, even for different peoples?
Yeah, so I guess it's best to start with definitions. And so I've done a lot of research showing how price inflation correlates with increases in broad money supply, although there are some exceptions. And so generally, there's monetary inflation, which is just an increase in the broad money supply, especially on a per capita basis. Then you have price inflation, which is basically the prices of things, usually commodities, but it trickles up to everything else, prices, wages, things like that going up. And then you have asset price inflation, where if you have a lot of money supply growth, but you manage to keep, say, commodity inflation low because maybe there's a lot of commodity abundance at that time, then that can instead translate into asset price inflation, where we pay more for the same stock. Basically, we're paying to pay more for the same stream of earnings in a stock than we otherwise would. And basically, it can kind of cause bubbles in financial assets. And so, the last decade, we're at the stage where monetary inflation was moderate. It wasn't low, but it wasn't super high either. And because if you look at broad money supply rather than just base money, so a lot of people look at the base money charts and it just goes like parabolic, but broad money supply was growing at kind of a moderately high pace. And because we were in a period of commodity abundance, a lot of that increase translated into asset price inflation instead. But now as we go into the 2020s, money supply growth has accelerated in many parts of the world. especially developed markets who've had more kind of fiscal space to do some of the fiscal activities they wanted to do, with the United States and Canada being among the highest in terms of, say, year-over-year percent change in broad money supply. And because our commodity markets are a little bit tighter than they were over the past decade, and because of this how quickly M2 is rising, we're starting to see bottlenecks in different sort of supply chains or commodities, and so that translates more towards actual price increases, where commodities go up, wages can go up, and basically shipping costs can go up, all sorts of things can trickle through, and you find yourselves with these periodic shortages. And so generally what you see is that the past two inflationary decades of the past century were the 1970s, the 1940s. And if we go back further than that, we can find the World War I inflations. Like the United States had big inflation in the the 1910s, and of course Germany had the big hyperinflation in the next decade. But if we just look at the past two ones, the 70s were characterized by rapid increases in the broad money supply and an oil shock, so an oil embargo. And so that caused that combination of commodity scarcity with rapidly rising money. And then the 1940s, of course, you had fiscal-driven inflation, and you had various commodity shortages related to the war. We even started making pennies out of a different material because we needed the normal material for the war effort and things like that. Basically, all the little details you need to get all the commodities you could. And so what we find ourselves in the 2020s is that money supply is going up at the fastest rate that it's gone up since World War II in many countries, with the United States and Canada kind of leading the way in terms of that percent change, while at the same time we're facing semiconductor shortages, shipping container shortages, things like that. Of course, because semiconductors are used in so many things, that trickles into used car prices and all sorts of things like that. And so my overall base case in the 1940s, in the 2020s, is it looks somewhat like the 1940s in the sense that you have these periodic spikes of inflation based on fiscal expansion. So based on fiscal-driven money supply going up, which means you're running large deficits to basically pump up the money supply, which is different than, say, the 1970s, which is more so bank lending based. And so if you look at the 1940s, you had three really big inflationary spikes. And you could call them transitory in the sense that it didn't keep. It's not like inflation kept just getting worse and worse and worse. It would have these really big spikes, and then it would calm down. However, it never like those prices never came back down. They just kind of went up, and they had a new plateau, and then they went up again, and they had a new plateau. And I see the 2020s playing out similarly, where you could have these periods of inflation that reach some eye-popping numbers compared to what we've had in the past 10, 20 years. But then they cool over, and some of those bottlenecks get resolved. But then if they do another big round of fiscal stimulus and kind of the next cycle, you can get another spike in inflation, and that can cool off. But each time the prices in general are just kind of hitting new plateaus. And there's there will be some areas like, say, lumber, that get really silly high, and they'll come back down. Whereas if you look at like a broad set of prices, those will generally be elevated after each one of those bursts of inflation.
Well, it's maybe you already talked about the definition of inflation, but it seems to me that some institutions like central banks or other economists we witness an inflation of theories of inflation.
Well, yeah, basically everyone has an idea of how it works, and so that's actually, I wrote like a recent article because I wanted to find correlations and find causes and kind of look through the history books and find out where it comes from. And basically, it's one of those things. There's that parable of like three different people are like blindfolded and they're touching like an elephant, and they're all touching like a different part. Like someone's touching the tusk, and someone's touching the ear, and someone's touching like the skin, and they're all describing something that sounds totally different. But really, they're just each describing a small part of what it is. And so I think that's the biggest risk that economists or forecasters have, is that they can be wrong without they're what they said might not be wrong, but it's just incomplete. And so that's always kind of the most challenging part of economic forecasts, is that one or two missing variables can change the direction, even if like say the 5 variables you were looking at ended up being correct. And so I think it's really important to step back and try to have the biggest possible umbrella framework and then kind of monitor that going on, and then test it. Like basically see if it's playing out the way you thought, and if it's not, then you quickly back up and say what variable am I missing? What is deviating from what I thought, and how can I adjust to compensate for that? Or if it is working, then that's a good feedback for the theory, and then you just got to keep monitoring to make sure things don't change.
So, if I take your analogy further, would you say that the ones that are basically the pilots and behind the wheel of all these institutions like central banks and also like governments through their fiscal policies are actually blindfolded behind the wheel?
I think partially, yeah. I think they have some of the answers, but not all the answers. And so if you look at their meeting minutes, I mean, they're often, kind of figuring things out like anyone else is. And kind of just saying like we don't know how it's going to play out, but here's what we're thinking, and so I think it's also one of those things where sometimes they know more than they let on because there's certain things you can't say kind of publicly because it's somewhat of a political role. It's supposed to be independent. There's still a political element to it, and so kind of like how politicians don't necessarily say what they mean. You have kind of a similar situation with central bankers where they don't want to be the cause of things. So they don't want to, if they talk about high inflation, that can be self-fulfilling. And so they always are kind of playing things down and kind of looking towards the median rather than kind of stoking up whatever extremes that things could go in. They're always trying to kind of push back to that middle.
Yeah, it's for example, when Jerome Powell says we're going into temporary inflation, he's not going to say, "Hey, markets, please panic. We're actually into inflation." So that's pretty obvious. But he also, in the meantime, is kind of like burying down Milton Friedman by saying that supply has nothing to do with inflation in one way or another.
Yeah, I think that. I mean, it's tough because we had this big M2 spike, this big broad money supply spike, and so if he were to say that that's highly correlated, well, then that's forecasting a very large inflationary spike, CPI spike, and so. And some of the models I've seen are looking at the potential for high single digit spike of inflation before kind of cooling off, and then it depends on what happens next with fiscal policy. But basically, if you look at the very long run, if you have kind of especially multiple years in a row of rapid broad money supply growth, that tends to pull up broad prices unless you have some really big deflationary force that's pushing prices down. And so, for example, in the United States in the late 1800s, they they had all this kind of land that they expanded into. And so they basically did not have this limitation of resources. They were able to expand, and so broad money supply could grow pretty rapidly without causing price inflation. You also had, for example, oil made things a lot more efficient. You had railroads come together. You had internal combustion engines. You had electrification. And whereas, for example, if you look at the UK, they were a little bit more constrained because they obviously, they had limited land. It's already, mapped out at that point. And so they didn't have this kind of abundance of resources. And so theirs was more correlated. Their money supply versus inflation was more correlated during that period. Similarly, in the past 20 years, we've had a wider than normal gap between broad money supply growth and CPI. It's not like, way higher than normal, but it's a little bit higher than normal. And it's part because we've done labor arbitrage. We've moved, we basically suppressed wages by moving jobs overseas to cheaper markets, and benefited from kind of another exponential burst in technology where you put everything on the internet and the smartphone, and so you kind of reduce a lot of costs there. And so the combination of that technology with that offshoring has been a deflationary force. And so the risk is that if you have rapid money supply growth that's accelerating here in 2020 compared to what it was last decade, and then you also say kind of reverse some of those other trends, or at least kind of stop accelerating them. So let's say globalization doesn't reverse, but let's say it just kind of, we don't keep having more and more global trade as a percentage of GDP, then that can start to bring inflationary pressures back home. And so one way to measure that is globalization is if you look at global trade as a percentage of global GDP, that peaked back in 2008, and then it's kind of been in this like, the data goes to I think 2019, so it's been in this like 11-year consolidation, and that might or might not come back down. But if it just stops going up, then basically we've kind of reached peak globalization roughly, and so that's hard to keep kind of exporting that inflation elsewhere. And so that's where you can potentially get more inflation in developed markets.
That's why Elon Musk wants to go to Mars, export it straight up to Mars.
Yeah, well, we have limited time, and I think I wanted to ask you two more questions. I'm not sure if well, we have hundreds of questions, but maybe two more, because you were talking about this broader look and an umbrella. You described it as an umbrella. Where would, and that of course is, I think, relevant, where would precious metals fit into this umbrella? Because, and you believe that there's a correlation between the performance of interest rates and precious metals, and what would this also mean for the role of, for example, gold and silver in the coming, foreseeing 10 years, or maybe the 5 years you were talking about earlier?
Sure. And so basically, precious metals have a bunch of different correlations, but one of their strongest correlations over the past 50 years, since they've been freely trading, is that they're inversely correlated with real interest rates. And especially, the one I use the most is the 10-year U.S. Treasury minus the prevailing inflation rate. And if you look at long-term data, then I use the CPI. If I look at shorter-term data, I look at inflation break-evens, because it's more real-time updating. And so basically, if you're in an environment where, so often people think of gold as an inflation hedge, which is only partially true. Because, for example, if you're in an environment where inflation's 4%, but the 10-year Treasury is 7%, then that's actually a pretty good vehicle for saving money, because you're getting a positive spread over inflation, whereas gold is a yieldless asset. Now, on the other hand, if inflation is only 3%, but the 10-year Treasury is 1%, well, then you're having negative 2% real interest rate on that Treasury. And so suddenly that zero yielding finite gold is a lot more attractive. And so that's, for example, why the 1980s, even though they were actually still somewhat inflationary, that was a bad environment for gold, because they finally had a period of yields being well above the inflation rate. Whereas if you look at periods in the 70s, you had these big spikes in inflation where yields didn't keep up. And so you'd go to like -4 or -5% real interest rates, and that'd be these huge spikes in gold. Similar thing for say 2011, where you had these fears about the central bank activities that were happening, and then you had a kind of a minor inflation spike, and real yields fell to below -1%, and so that was a great kind of spike for gold. And so overall, over the long run, gold follows, roughly speaking, broad money supply per capita, and then also the way that it fluctuates around that trend largely depends on what real interest rates are doing. And so because we're in an environment now of where government debts are so high around the world, they have a strong incentive to hold rates very low while inflation running above trend. And so that is a very good environment for negative real yields, which is a very bad environment for cash holders or bond holders. But that tends to be a good environment for gold, and then generally silver follows gold as well. And so overall, when you look at just where gold fits in the grand scheme of things, I like it as part of a portfolio along with gold miners, because that's kind of a hedge against, partially a hedge against inflation, but more specifically a hedge against inflation that is not accompanied by a rise in yields.
What's your favorite precious metal?
I like all of them. I like them for different purposes. I have gold, silver, and platinum. And then I also like, kind of base commodities like, copper or uranium or oil, for example. I kind of go across the board based on different cycles that are happening and based on what's attractively priced.
Final question, because we don't want to take up too much of your time. Lyn, if you were the architect of a new monetary system, what kind of construction would it resemble and why?
Well, that's challenging because it depends on how much buy-in you can get from other stakeholders. But essentially, you'd want the kind of the global money to be separate from any one country's money system. And so that could take the form of the Bancor idea, or it can take the form of precious metals, or even a digital ledger. But basically, when you have one country's currency also serving as the global medium of exchange and store of value, that causes kind of these structural imbalances in the system, where, like I said before, basically as long as the United States Treasury has been this kind of dominant reserve asset, That's kind of pushed open the U.S. trade deficit so that we kind of have a more structural trade deficit than we would if we didn't have the system in place. And so basically to reduce imbalances, the kind of long-term balance in the system, you need a way for all currencies to kind of, trade based on how their economies are doing. And so that could be something like gold. It could be something like a Bancor or something like that. But whatever it is, it has to be kind of separate from any one country's currency in order to work smoothly.
Like Bitcoin?
If it gets big enough, it's one of those things. I mean, Bitcoin at $1 trillion market cap is not big enough. It's too volatile. But if one day in the future, if Bitcoin's worth 20 trillion, well, then it's big enough to serve that role, especially if the volatility goes down. But at the current time, it's not big enough.
We've seen in the past 2 days a pretty steep, ugly correction in the cryptocurrency market. Stocks went down as well, bonds went down, but precious metals didn't really. Actually, gold even increased a bit. How did you look at it?
So I've been bullish on precious metals in this cycle since late 2018. And it wasn't until early 2020 that I became bullish on digital assets, particularly Bitcoin. And one thing I pointed out in my August 2020 newsletter was that real rates at that time were somewhat bottoming and turning up a little bit as the 10-year Treasury started to rise. And so my overall view then was that I remained long-term bullish on gold, but that I thought it might take a correction. And I wasn't sure how deep or long that correction would be. But it's kind of like I think we played out the first kind of phase of this, and it needs to take a break. And I was more bullish on digital assets at that time. And then in the past several weeks, I've been tracking kind of this bottoming process in gold, while we've seen somewhat of a pressure in Bitcoin and other digital assets. And so basically, what we're seeing, I think, a lot of this was caused by the fact that the Grayscale Bitcoin Trust, their premium to NAV went negative. And so basically that took away that big source of buying that was happening. And because that was happening, that kind of put downward pressure on the price. And so we've been in this kind of multi-year consolidation, multi-month consolidation. And so now when you have kind of a weak kind of technical environment, and then you have, say, the Elon Musk drama and some of the other things that are happening, that was kind of recipe for a big price correction. And so I remain kind of long-term bullish on Bitcoin, but right now there's unclear, say, price direction, whereas gold is continuing to benefit from this kind of re-steepening of inflation expectations, while nominal treasury yields are not keeping up. And so basically I remain a kind of more near-term bullish on gold, whereas Bitcoin is uncertain for the next couple months.
Fair enough. We're going to round off. I always like to finish with one funny question you can answer in one sentence. If you could switch your brain for one day with a person, who would that be?
Oh, that's really hard. I guess it depends on...
It can be living or actually even someone who already passed away.
It's basically a challenging question. You can go in multiple directions. I guess I'd have to go... you can go kind of in history, right? So you can say like someone like the Buddha to see what say he experienced. It's another really good one is to pick someone close to you to fully see how they see the world. And so, for example, I'd pick my husband so I could see basically how he sees things, or how to basically better understand him, because I think that actually, if anything, would have the most applicable use in daily life. So I think I'd have to go with that one.
Okay, good. Fair enough. I love it.
Good answer.
Thanks a lot, Lyn. We're really grateful for your time, for your knowledge, your precious insights. Just like gold, it's also limited in time, so we gotta run this off. Thanks a lot also for the viewers and the listeners on the Gold Republic podcast. You can find our podcast on Spotify, on iTunes, and other podcasting platforms. If you found this episode valuable, you can give it a like. If you haven't subscribed yet, this is the subscribe button. Comment sections down below on the YouTube section. Bart and I can answer them, and also even Lyn, but I guess not. Yeah, I have lots of interviews and other things to do. And Bart, on your note, finishing.
Well, Lyn, thank you very much. Of course, everybody who's been watching this on the YouTube channel, subscribe, like it, please, and we'll see each other in the next episode of the Gold Republic Podcast.